Hey guys, Max here, and yesterday the markets were pretty damn bad. They were red across the board. There wasn't much good news at all, and I don't know if there's going to be any good news anytime soon. We will cover all of that today, so let's just get right into it. So how bad were markets? Well, they were this bad. It looks like every major sector fell. Well, it did. Tech, of course, did the worst, as we have come to expect, excluding crypto, of course, but that did even worse than tech, but we'll cover that in a moment. Financials did poorly, though, as did healthcare, energy and consumer defensives, industrials and real estate too. Literally every major sector fell, and the big cap companies, the most influential, fell the most. Tesla down almost 5%. Obviously, that's a volatile stock and that's not unheard of, but still a big move. Microsoft down 4%, Apple and Amazon down over 2% each, and Google down more than 3%. So really, just wow, a pretty awful day to have money in the markets. The S&P 500 fell by 1.7% by market close. The Nasdaq fell by 2.2%. And over in Europe, stocks didn't do much better. The FTSE 100 fell by 0.7%. The Stoxx 600 fell by about that same mark. All over the world, stocks were down basically, and the MSCI World Index reflected that, falling 1.3%. Now, the dollar is actually looking quite strong recently. Despite huge recession fears, the US dollar is still seen as the safest currency in the world, despite de-dollarization attempts by countries like Russia, China, India, and Saudi Arabia. The petrodollar is still very much alive to many people's dismay. The yen had another bad day, falling about 1%, following what is actually an awful year of really consistent declines, meaning that the yen is down 8% year to date. I might make a video on this if people are interested, but let me know in the comments down below. Now, bonds continue to see their prices fall and their yields rise, to absolutely no one's surprise. The US 10-year Treasury yield rose another 7 basis points, now sitting at 2.77% once again. Once again, I've said this so many times now, that is another 3-year high, and we should expect more of those highs in the future too. German 10-year yields rose 11 basis points yesterday, and British yields rose 10 basis points, so this rout from fixed income assets is being seen across the world, not just in the US. Now, oil prices continue to fall, which is, again, really nice to see. WTI crude oil is down another 3% yesterday, now sitting at about $94 a barrel. Not quite as low as it was back in January, but a far nicer price than we saw over recent weeks. Hopefully we do see more downwards action there, but probably not for today itself. Brent crude oil in Europe dropped below $100 a barrel, touching $99 yesterday. But as it stands right now today, as I make this video, prices spiked up another 4%. And now prices are $104 a barrel, so no respite in sight there, sadly enough. Gold has seen a few days of strong performance, with prices rising 0.5% yesterday. Now it's sitting at about $1,960 an ounce. Still, there is room to move upwards for gold in my opinion, but then again, I've been buying into gold over recent months, so of course I would think that. Either way, compared to risk on assets, gold really is proving itself to be a brilliant safe haven asset right now. Finally, for the markets today, crypto had an absolutely disastrous day as well. Bitcoin was sitting pretty at about $43,000 for a while, but it did really poorly over the last day and lost almost 10% at one point, dropping below $40,000 and into the $30,000 mark for a time. As of right now, Bitcoin is literally just $100 above 40k, finding some degree of support there. Now, this downwards trend was of course seen everywhere. Ethereum has fallen to $3,000, ADA has fallen below $1, Solana is touching $100. Basically, everything fell in the region of 10% over the last day, meaning something like $150 billion of value in the crypto sphere has been erased in one day, so not good news at all. Now, in short, as I'm sure you can gather from what I just told you, the markets were really unhappy yesterday. They had a rest over the weekend, but when they opened back up again, it was utter chaos. And why is that? Well, the usual fears are all present as always. COVID, inflation, recessions, energy prices, the war in Ukraine, China's lockdowns, and Russia's economy are all playing on investors' minds right now, but there were actually a few real developments that acted as a trigger for all of this bad news. We will get inflation data from the US today, and we are expecting it to be very bad because it will include the energy price spike we saw as the war kicked off. The White House literally came out and said inflation is going to be extraordinarily high, which is very worrying. They've never said that before. Now, some people are saying that this is going to push the US above 10% year-over-year inflation, which again would be disastrous, but to be honest, I think that's very unlikely. Personally, I'm expecting maybe 8.5% year-over-year inflation with maybe 1.2 or 1.3% month-over-month. Now, this still would be awful and it's ridiculous numbers, and once again, these numbers are already doctored by the Bureau of Labor Statistics to ensure that they aren't as high as they really are in reality, with things like owner's equivalent rent, which is basically just a fraudulent measurement of inflation. Now, most estimates are gunning for something in the region of 8.2 to 8.8%. Credit Suisse, Morgan Stanley, and Goldman Sachs are all thinking 8.6%. And I think that all in all, yeah, that's probably right. 8.5% is probably where we're going to end up. I actually think that when you watch this video, that data will be out. But as I'm making it right now, it isn't out yet. Now, there is something I need to mention here, and that is the fact that we've now had high inflation for about a year, which means that the month-over-month figures are probably going to remain very high, but the year-over-year figures will slow down and stop growing so much. Now, this doesn't mean that inflation is decreasing, it's just a function of the time frame we measure inflation over. If we see consistent 0.8% inflation every month, well, for the first year of that, the year-over-year data is going to be starting at 1% and getting worse consistently until it reaches around 10%, and if that 0.8% inflation continues there, then the year-over-year figures will actually stagnate at this point. This doesn't mean that inflation has stopped though, it doesn't mean that it's slowed down either, it still means that prices are rising at that stupidly high rate, it's just that that stupidly high rate is now sort of normalized. Just make sure that you do not allow the media to tell you over the next 6 months that as the year-over-year figures have stopped growing by so much, that inflation is fixed and it's not a problem anymore. It is not fixed and it won't be fixed until we see inflation month-over-month figures fall back down to 0.1 or 0.2% on a month on a consistent basis. Now, the next big problem we have in the markets is once again fears about the Russian invasion and the war in Ukraine. This time focusing around the city of Mariupol, which has now been under siege for 48 days. Yesterday, we got reports from soldiers in the city. Some Ukrainian soldiers have claimed they are being attacked by Russian chemical weapons. This, if true, would be a huge escalation of the war by Russia and would really shake markets, as it would pretty much guarantee further sanctions against Putin and Russia. Is this actually true? Well, it's very hard to say. The Ukrainian government itself has said that it can't confirm if these claims are accurate or not. The nature of this siege in Mariupol means that information is slow and unreliable at best. Of course, Russia is saying they have not used chemical weapons and they will not, but I am going to link to a video in the description down below that is literally 1 day old, where a Russian military officer goes on Russian state-run TV and says that they should use chemical weapons in the siege in Mariupol. This is, again, literally just 1 day old, and it comes just before we got reports of Russia maybe using chemical weapons in Ukraine. We know they have a history of using chemical weapons as well, so it is entirely feasible that it's true. We don't know if it actually is, but it is entirely possible, and the markets are pricing it as if it might be. Next, and again with Russia, we have just seen the Russian government default on its debt payments because it is refusing to pay out its required payments in dollars and is trying to pay out in rubles instead, which is by definition a default. Russia claims that they have the money to pay this debt, but they just can't access it as it's locked overseas due to sanctions, so it isn't a real default, but that is utter nonsense. The simple truth is that it doesn't matter why their debt isn't being paid, the fact is that it isn't, and that means they are in default. There is, though, a 30-day grace period where Russia has to get that cash together and pay it off, but it isn't looking too bright for Russia right now. Finally, there is still utter chaos in China. Shanghai has been shut down for about a week now, but the rest of the media is finally paying attention to it. There's also lots of video emerging of what looks like rioting in Shanghai, and there are also videos of COVID enforcers, these police and healthcare workers who are forcing people into quarantine camps, being attacked by civilians. There is, without a doubt, trouble in China right now, and the markets don't like that. Now, at the same time as this is happening though, the CCP, the Communist Party, is pledging lots of support for the economy and basically turning the money printer on, doing what the US did 2 years ago, flooding the markets with liquidity, trying to prevent a market crash. As we have been seeing though, this kind of strategy can only work for so long, and in the end, it will just result in an even worse crash when the support finally fails to do its job, as we are seeing in the West right now. Now, all of these reasons and more are why the markets took such a bad turn for the worse yesterday, and with what inflation is looking like today, we shouldn't really expect anything much better in the near future. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, so if that sounds interesting, then make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stable coins like USDC, which is a far higher rate than you get from any savings account these days. Thank you for watching. Stay stoic. Until next time.